Today, I want to talk about how two Citadel traders have lost over $300 million or 30% of their fund in a year where so far the S&P 500 is up nearly 20%. I want to explain how this is indicative of Citadel shifting their short positions. And I also want to talk about why brokers have been selling synthetic shares in MULN. So stay tuned and let's make some money. And now I want to dive straight in with the key information. So, Frank tweeted saying Citadel alumni have taken a $300 million loss. So it says one of the most anticipated hedge fund launches of recent years has turned into a disaster. Two Citadel traders have lost approximately $300 million this year alone. So the article written just a day ago on the 31st of August says Citadel alums or alumni have taken a $300 million loss. So it says their fifth delta hedge fund that bets on rising and falling stocks lost about 13% in the month of July alone, extending declines for 2023 to as much as 29%. The fund began with about $1.3 billion, implying current losses of over $300 million. And obviously, as Fifth Delta has said, this wasn't supposed to happen. And now as a result, Fifth Delta are trying to raise money again, trying to claw their way out of a deep financial hole. And it says the fund's abysmal performance is all the more shocking and all the more confusing given this year's bull market. The S&P 500 is up over 18% this year so far. We can see just by filtering year to date, the S&P 500 is up 18.52%. All these traders from Citadel had to do was buy S&P 500 and they'd be up 20%, not down 30% on their fund. And if they bought specific individual stocks like Meta, Nvidia and Tesla, they'd be up hundreds of percentage points. But yet somehow this fund has lost $300 million or 30% of their fund. I'm personally wondering if these Citadel traders had made money in their fund somewhere, but had also taken on heavy losses elsewhere. Maybe they did buy Nvidia, Tesla and Meta stock, making hundreds of millions of dollars, but potentially bore some losses from the main Citadel entity, taking losses elsewhere, resulting in a net loss. Obviously, this fund, Fifth Delta, is separate from Citadel LLC and Citadel Securities. Obviously, Fifth Delta isn't owned by Ken Griffin himself, just owned by two Citadel traders. But I wonder if Ken Griffin made some kind of deal where he would provide seed capital to these traders in exchange for taking on some of his loss. Maybe they went on with their seed capital to make money elsewhere on stocks like Nvidia, Tesla, Meta and others, but also bore some of Ken's heavy losses elsewhere in their fund. But interestingly, this article also says there are more hedge fund closures than openings these days. Institutions are putting their money with the big players, not upstarts like Fifth Delta. And interestingly, it says long term, I think the long short strategy of Fifth Delta and so many other funds is a loser. The long term trend in markets is upwards, meaning you'll lose money on your shorts eventually. Which is obviously very, very true. If we look at the general direction of the S&P 500 over the last 30 years, the markets always go upwards. So over the long term, shorting is never profitable because even though sometimes stocks or entire indexes go down, they always come back up again in the long run. And what's more, short positions are costly to maintain. You've got to pay interest on the shares you borrow. And even worse, your gains are capped at 100% of the money you employ. Obviously, a stock can fall from $10 to $0, but it can't fall lower than zero. And meanwhile, your potential losses are unlimited. This obviously couldn't be more accurate. In specific stocks like AMC, these shorts are paying borrow fees of 100, 200, 300, 500, even 1,000% per year. You could say the AMC cost to borrow fee has temporarily decreased as a result of the reverse split, which it has temporarily. But remember, for months prior, that interest rate was fixed at 1,000%. These shorts likely racked up multiple times their short position in just borrowing costs and losses alone, and that's why they are still stuck to this very day. Now, Biotech Moose has an excellent theory or just potential flat out fact as to why these brokers were selling synthetic shares in MULN. So obviously MULN is an EV company just like Tesla, Lucid, and importantly RIVN. So MULN Automotive is now suing a number of brokers like TD Ameritrade, Charles Schwab, National Financial Services or Fidelity, and other individual John Does. So at the moment RIVN is the number 2 EV company behind Tesla, but check out who holds shares in the RIVN entity. So it says here global asset firm T. Rowe Price is also a large investor, and other financial companies that invested prior to the IPO include Fidelity Management. And the trading name of Fidelity or Fidelity Management is National Financial Services LLC, who's just been brought into that lawsuit by RIVN. But it doesn't stop there because Charles Schwab also owns a significant number of RIVN shares, 1.65 million shares worth $27 million. And therefore getting rid of RIVN's competition, like MULN Automotive, is good for Charles Schwab and for Fidelity. Also remember TD Ameritrade is owned by Charles Schwab because TD Bank Group sold TD Ameritrade to Charles Schwab, and therefore it's also in their interest to synthetically short MULN as well. The worse MULN performs, it makes RIVN look like it's performing even better. And therefore in theory, the more the share price of MULN goes down, the less competition RIVN has, and their share price goes up. T. Rowe Price Associates is also another defender in this MULN lawsuit and is also a big investor in RIVN. T. Rowe Price led a $2.5 billion investment round into the EV startup RIVN, and therefore it's also in their best interest that MULN performs worse so that RIVN in comparison can perform better. So actually it now almost makes sense as to why these brokers have been selling synthetic shares in MULN, because as MULN performs worse, RIVN comparatively performs better and their investment gets larger. That's also likely why the same manipulation is seen in AMC, because the worse AMC performs, the better streaming services like Amazon Prime perform instead. So those large investors in Amazon like Citadel are going to synthetically short AMC, so comparatively streaming services like Amazon and Netflix do better. And Financial Journey is also tweeted saying it's crazy to see 78.66% of the daily volume redirected to the dark pool in MULN. Obviously AMC sees the exact same thing on a regular basis, upwards of 70 if not 80% of daily volume all going off exchange. So obviously it seems the exact same thing is happening to MULN as what happens to AMC, likely by the exact same brokers. Now I received a comment in my video yesterday saying this agreement with Taylor Swift will barely make any money for AMC. They'll barely sell any tickets and it will have a terrible margin. And it seems that comment has already been proven false and proven to be a shill's comment, because Taylor Swift's The Eras Tour concert film sets new AMC theatres record. $26 million in advance ticket sales were sold in one singular day on Thursday, marking AMC's highest ever advance sales day in its 103-year history. Not just a post-pandemic singular day sale record, but a new record for its entire 103-year history. It seems AMC is now regularly setting new records, setting new profit records, new revenue records, new box office records, and now new singular day revenue records. As I said yesterday, unless somehow the shorts can infiltrate AMC and stop AMC making profit, AMC will not be going bankrupt. And when AMC does not go bankrupt and instead gets more and more profitable, more and more funds will buy shares of AMC, pushing the price upwards. The other week I spoke about the stock BKNG or bookingholdings.com. They performed a reverse split back in 2004, when the share price was down at around $20 per share, and now the stock trades at over $3,000 per share. The reverse split was never bad for booking.com because they continued generating more and more and more profits. And over time their stock rose from lowest at around $7 or $8 per share over $3,000 per share. Their market cap is also not $1 or $2 billion, their market cap is over $100 billion, meaning that AMC has room to multiply its share price by 100x, if not by 1000x, if not potentially even more. Now in yesterday's video, I spoke about stock and crypto plays wanting to be appointed and wanting to infiltrate AMC's board. He made a video responding to it, which I'll be honest, I didn't watch a lot of, but I thought it was very interesting. In my video, I explained why he likely works for the shorts and why he's trying to infiltrate AMC to stop it generating profits. And his entire reply was basically, no, you're the one that's paid by the hedge funds, with no proof whatsoever. His entire response was basically saying, I know you are, but what am I? Which I don't think I've heard since I was like 10 years old. Obviously, I've always been honest and I've told you guys if I ever was paid by the hedge funds, you wouldn't see me in this setup. You'd see me on a desert island somewhere kicking back, enjoying the view with my millions that I've been paid. Unfortunately, I haven't been paid millions. I've still got a neon sign in the background which costs like $20 or $30. Now, the reason why I found it interesting is because Stock and Crypto Plays has just 12,000 subscribers, which I'm not knocking him for. It's always good to see YouTube channels growing and gaining subscribers. But I found it interesting because Investor Place wrote a specific article all about him. Their article calls him a popular YouTube commentator and speaks about how he wants to join AMC's board to make a difference. Now, in all my time making YouTube videos, I've never ever had a news article written about me. Maybe I'm not popular, maybe I'm just boring, but I've never been contacted by a news agency. The reason why I found this interesting is because Investor Place is owned by MarketWise. Now, MarketWise is a listed company, and the people that hold the majority of the shares in MarketWise and in Investor Place is, you guessed it, BlackRock, Vanguard, Geode Capital Management, and State Street Corporation. So Stock and Crypto Plays has likely worked alongside Investor Place, aka worked alongside State Street, to write an article about how he wants to join the AMC board. aka Stock and Crypto Plays is literally working with the exact same people that hold put options in AMC to write a news article. Now, I don't want to turn this into a giant beef, which is why I'm not going to name the title of this video after him. I just wanted to put that fact out there. So guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.